If you're looking at silver right now, it feels like the floor just gave way. In a single trading session, the price dropped hard into the mid-$70 range. Screens flashed red. Charts broke down, and across social media, the reaction was instant. Fear, anger, confusion. Retail traders are dumping positions. Commentators are yelling, manipulation. Everyone is staring at the same chart and asking the same question. How can silver be crashing when demand is supposed to be exploding? But here's the uncomfortable truth. If you're panicking, you're looking at the wrong market. Because the most important silver price on earth right now is not set in New York, not on futures exchanges, and not by hedge funds. It's being set quietly, physically, and aggressively inside the vaults of the Shanghai Gold Exchange, while Western markets are selling silver around $74. Buyers in Shanghai are paying more than $80 for the same metal. Earlier, they were willing to pay even more. That's not a rounding error. That's not volatility. That's a structural fracture. In global commodity markets, price gaps like this are not normal. Arbitrage is supposed to erase them almost instantly. If silver is cheaper in one place than another, traders should buy low, sell high, and close the spread. But that isn't in T happening, and when arbitrage fails, it tells you something powerful. The asset you were trading on screen is not the same asset changing hands in reality. This is the first clue that the silver market is no longer unified. What you're seeing in New York is a paper price. Contracts, promises, leverage. What you're seeing in Shanghai is a physical price. Bars, vaults, delivery. And those two worlds are drifting apart. This is why today's sell-off is so deceptive. On the surface, it looks like weakness. Underneath, it's evidence of stress. Stress caused not by speculation, but by policy. Written into law, buried in regulatory language, and ignored by almost everyone watching the charts. To understand what's happening, you have to stop thinking like a trader reacting to candles. You have to think like a system. Because this didn't start with markets. It started with governments. Over the past year, the United States rewrote the rules of global trade. Tariffs were raised, exemptions were carved out, and supply chains that had been stable for decades were suddenly forced to reroute. Public attention focused on the obvious targets. Cars, electronics, solar panels, semiconductors. That's where the headlines were. That's what politicians argued about on television. But the most important change wasn't in the headlines, it was in the footnotes. Inside a dense legal framework tied to reciprocal trade enforcement, there was a quiet decision made, one that acknowledged a problem Washington couldn't escape. The United States consumes enormous amounts of silver, its military systems depend on it, its medical devices depend on it, its energy transition depends on it. But the U.S. barely produces any. If raw silver had been hit with the same trade penalties as finished goods, the result would have been immediate industrial damage. So instead of taxing it, lawmakers did something unusual. They exempted it. Raw silver bullion was quietly placed into a special category, allowed to enter the country without the penalties applied to almost everything else. On paper, this looked like a technical adjustment. In reality, it created a distortion so powerful, it's now ripping the global market apart. Think about the incentive structure that creates if you import a finished product, you get punished. If you import the raw metal to build that product domestically, you don't. That single choice sends a message to every manufacturer on Earth. Bring your factories here, we'll make sure you can get the metal. But here's the problem. Metal doesn't move because governments want it to. It moves because prices force it to. And right now, the price in the West is lying. The US market says silver is worth $74. Shanghai says it's worth more than $80. And buyers there are proving it with cash, not contracts. That difference is the sound of physical supply tightening. It means real metal is flowing east, not west. It means vaults are emptying in one region and filling in another. And it means the so-called global silver price no longer reflects reality. So why did the price drop today? Because paper markets don't respond to shortages the same way physical markets do. Paper markets respond to leverage, margin requirements, and forced selling. When conditions tighten, the fastest way to create liquidity is to shake out weak hands, raise the cost of holding positions, force liquidation, push price just low enough to trigger fear. That's exactly what this move looks like, a flush, not a failure. While traders are selling contracts, someone else is buying bars. While stop losses are getting hit in New York, physical metal is disappearing into Asian vaults. This is the disconnect. And it's happening at the worst possible moment, because timing matters. At the same time, the U.S. is trying to pull industrial supply chains back home. Other countries are doing the opposite. They're tightening control over their own resources. Export rules are changing. Strategic materials are being prioritized domestically. When producers decide to keep metal inside their borders, price stops being a suggestion. It becomes a gatekeeper. That's why Shanghai is paying a premium. They're not speculating. They're securing supply. And this is why today's price action is so dangerous to misunderstand. If you think this drop means the story is over, you will sell at the exact moment the real pressure begins. If you think silver is weak, you'll miss the signal hidden inside the spread. Because this market isn't breaking down, it's splitting in two. On one side, paper, leverage, liquidation. On the other, physical demand, policy-driven scarcity, and strategic hoarding. And the law, not speculation, is the wedge driving them apart. In the next part, we're going to move beyond prices and into industry. We're going to look at what happens when factories are forced to relocate, when raw materials become choke points, and when demand doesn't just rise, it becomes mandatory. Because the real silver squeeze doesn't start with investors, it starts with manufacturers who cannot function without the metal. And once they enter, the market price stops being optional. To understand why silver is being pulled apart like this, you have to step away from trading desks and look inside a factory, not a mint, not a vault, a manufacturing floor. Because the next phase of this crisis has nothing to do with investors chasing returns, it has to do with companies that cannot operate without silver and have no alternative when it disappears. For decades, global manufacturing followed a simple rule. Build where it's cheapest. Labor, logistics, and supply chains were optimized for efficiency, not resilience. Solar panels, electronics, precision components, much of it was produced overseas and shipped into the United States as finished goods. That model worked until it didn't. When tariffs began targeting finished products instead of raw materials, the math collapsed overnight. Suddenly, importing a completed item carried massive penalties, while importing the raw inputs did not, for manufacturers that created a brutal choice. Pay the tariff and destroy your margins. Or move production. This is where silver becomes unavoidable. Modern industry doesn't use silver as decoration. It uses it because nothing else does the job as well. Conductivity, durability, reliability under stress. Silver isn't optional. It's embedded in electronics, medical devices, defense systems, and most critically, energy infrastructure. Nowhere is this more visible than solar. The photovoltaic industry has quietly become one of the largest consumers of silver on Earth. High-efficiency solar cells require silver paste to function, and despite years of experimentation, there is no true substitute that delivers the same performance at scale. Manufacturers tried to reduce usage. They tried thinner lines. They tried alternative materials, but physics won. As new, more efficient cell technologies rolled out, silver intensity stopped falling and started rising again. At the exact moment, policy forced factories to move technology demanded more metal. This is what creates an industrial vacuum. Factories relocating into the United States don't bring silver with them, they bring demand. Massive, continuous, non-negotiable demand. And this is where the imbalance becomes impossible to ignore. The United States consumes many times more silver than it produces. According to data compiled by the United States Geological Survey domestic mining supplies only a fraction of what American industry requires each year. The gap has always been filled by imports. But imports only work if exporting countries are willing to sell. That assumption is now breaking down. Across the world, resource-producing nations are reassessing what they ship abroad. Silver isn't just a commodity anymore. It's a strategic material. Countries that mine it are increasingly aware that sending raw metal overseas means importing finished goods later at a higher cost. So they're tightening supply. This is resource nationalism, and it changes everything. When producers restrict exports, price becomes less about profit and more about priority. Who gets the metal, who doesn't, and at what cost? This is why the premium in Shanghai matters so much. It's not speculative enthusiasm. It's industrial urgency. Buyers there are paying more because they must secure supply before someone else does. Meanwhile, U.S. manufacturers are being pushed into the same competition, but with one critical disadvantage. They don't have domestic metal. So what happens when demand surges while supply contracts? You get bifurcation. Paper markets continue to trade expectations. Physical markets trade necessity. And necessity always wins. This is why the recent price drop is so misleading. Futures markets are responding to leverage mechanics, margin calls, risk management, forced liquidation. But factories don't operate on leverage. They operate on inventory. If you rerunning a solar plant, a defense contractor, or a semiconductor line, you can hedge away a missing input. You either have silver or you shut down. That reality is already influencing procurement behavior. Large industrial buyers are no longer shopping for the lowest price. They're shopping for guaranteed delivery. They relocking in supply even if it costs more, because the cost of not having silver is catastrophic. This is where the investor narrative breaks down. People assume silver demand comes from sentiment, from fear, from inflation hedging. But industrial demand doesn't care about sentiment, it cares about throughput. And when throughput is threatened, price elasticity disappears. This is why companies like Tesla, Samsung, and First Solar are watching this market closely, not because they want exposure, but because they need assurance. If supply tightens, further competition for physical silver doesn't happen on exchanges, it happens through contracts, direct sourcing, and off-market deals. That metal never shows up in public inventory numbers, which brings us to another critical signal: warehouse levels. Registered silver, the metal actually available for delivery, has been declining. Quietly, persistently, each drawdown reduces the buffer between paper promises and physical reality. Markets can function with thin buffers. They cannot function with empty ones. This is why the disconnect is accelerating. Paper prices can be pushed down temporarily, but physical shortages don't respond to charts. They respond to absence. In absence compounds, every new factory increases baseline demand. Every export restriction reduces supply flexibility. Every delay pushes buyers to pay up to secure material ahead of rivals. This is not speculation, it's accounting. At some point, the system reaches a breaking point where price must rise. Not because traders demand it, but because industry enforces it. And that rise doesn't happen gradually. It happens when buyers stop asking what silver costs and start asking whether it's available at all. We are approaching that threshold. The policies designed to encourage domestic manufacturing have created a demand shock. The global response has created a supply shock. And between them sits a market, still pretending price is set by futures contracts. It isn't. It is set by factories that cannot operate without silver and are increasingly willing to pay whatever it takes to keep running. In the final part, we're going to look beyond supply and demand and into the financial system itself, because the consequences of this imbalance don't stop at commodities. They reach currencies, interest rates, and purchasing power. And once that layer starts to crack, silver stops being just a metal, it becomes a signal. Up to now, we've talked about silver as a commodity, a raw material, an industrial input being squeezed by policy and scarcity. But this is where the story turns dangerous. Because the same laws that fractured the silver market did not just distort supply chains, they trapped the financial system itself. And once that happens, price stops being an output, it becomes a consequence. To see why, you have to understand what tariffs really are. They're not punishment for foreign countries. They're not leverage in negotiations. They are taxes. When a tariff is placed on imported goods, the foreign producer doesn't pay it, the importer does, and that cost is passed directly through to consumers and businesses. This is called cost-push inflation. Prices rise not because demand is strong, but because inputs are more expensive, and once cost-push inflation sets in, central banks are supposed to step in. Normally, this is where the Federal Reserve would act. Inflation rises, interest rates go up, borrowing slows, demand cools. That's the textbook response. But this time, the textbook doesn't apply. The entire goal of the new trade framework is to restart domestic manufacturing, to build factories, expand capacity, and bring production home. Factories don't get built with cash, they get built with debt. If interest rates spike, those projects collapse before they begin. Loans become unaffordable, capital dries up. The very reshoring effort tariffs were designed to encourage get strangled. This is the trap. Raise rates, and you kill manufacturing. Keep rates low, and inflation accelerates. There is no painless option. So the system chooses the one that preserves industrial momentum, even if it quietly destroys purchasing power. That's financial repression. It means your savings earn less than inflation. It means currency loses value in real terms, and it means hard assets begin to reprice upward, not because they re-scarce alone, but because money itself is being diluted. This brings us back to silver. Ask yourself why bullion was exempted from tariffs in the first place. Not finished goods, not components, raw metal. That exemption wasn't just about industry, it was about confidence. The architects of this policy understood something fundamental. If you are going to engineer inflation through trade barriers, you have to leave an escape valve. A way for capital to move into real assets. Gold and silver have played that role for thousands of years. By leaving bullion untaxed, policymakers created a two-tier system. Tier 1, consumers and wage earners. They pay higher prices. They hold currency that buys less each month. Tier 2, asset holders. They own things that cannot be printed. They benefit from the inflation others absorb. This is how wealth transfers happen, quietly, legally, inevitably. And it's already visible in the data. Gold has been rising steadily, reflecting currency stress, but silver has lagged. Not because it is weak, but because it is being restrained by paper markets that still assume infinite supply. That assumption is about to fail. The futures exchanges, like those operated under the CME group, rely on one critical belief: that most contracts will never demand delivery. They're designed for cash settlement, but industrial buyers don't settle in cash, they settle in metal. When manufacturers enter futures markets, they aren't hedging price risk, they're securing supply, and when they stand for delivery, paper games stop working. This is where pressure becomes exponential. If even a small percentage of contracts demand physical fulfillment, inventories evaporate. Exchanges are forced to choose between default, cash settlement, or emergency rule changes. Any of those outcomes shatter confidence. And confidence is the only thing holding paper prices below physical reality. We're already seeing the early signals. The premium in Shanghai isn't speculation. It's a vote of no confidence in paper pricing. It says, We don't believe you can deliver at this price. Once that belief spreads, arbitrage flips direction. Instead of smoothing markets, it drains them. Metal leaves the cheapest venue and flows to the highest bidder. That bidder right now is not a hedge fund, it's industry. This is why the gold to silver ratio matters so much. Historically, in periods of inflation and industrial stress, the ratio compresses sharply, not because gold falls, but because silver rises to reflect its dual role, monetary asset, industrial necessity. At current levels, the ratio implies silver is severely underpriced relative to gold. Even a partial reversion would require a dramatic repricing. And that's without considering shortages, add supply constraints, add export controls, add mandatory industrial demand. The math stops being theoretical. At that point, price must rise to ration demand. There is no alternative mechanism. This is why the recent dip isn't weakness. It's the final release of pressure before repricing. Paper markets can push prices down briefly. They can scare retail traders. They can flush leverage, but they cannot create metal. And when the realization hits that physical silver is not available at the posted price, the market doesn't adjust politely. It gaps. So what happens next? The moment physical buyers refuse to sell below their replacement cost, paper prices lose relevance. The official price becomes a reference, not a clearing level. Real transactions move off exchange, premiums widen, delivery times stretch, inventories vanish, and eventually the paper market is forced to follow the physical one, violently. That is how every commodity squeeze ends, not with a rally, with a reset. The legal framework is already in place, the factories are already moving, the currency pressure is already building. Silver is sitting at the intersection of all three, which means the question is no longer if the anomaly corrects. It's how fast. When it does, the price you see today won't matter. What will matter is whether you understood the signal while it was still ignored. Because once paper and physical converge, there is no warning bell. There is only repricing, and by then, the only thing that matters is what you hold, promises or metal.